Welcome everyone to this session on the role of credit rating and sustainability regulation in capital allocation to PDBs. So what we're trying to do in this session is to explore how DFIs and PDBs can enhance their roles in financing sustainable development by actually integrating innovative financing mechanisms using harmonized regulatory standards and applying refined credit assessment methodologies. These three approaches, we think, should be a very useful contribution to strengthening the global financial architecture and how we mobilize capital effectively as PDBs. Between Nicholas and I, we've assembled quite a formidable list of speakers here to take us through this topic. And the way we're going to run it, we're going to do it in two panels. We're going to have the first set, and then we'll move over to the second set. But we want to introduce all the speakers right up front so that when we change the panels over, we don't waste time. So let me start, and then I'll give it to Nicholas to just introduce the colleagues. So we've got Professor Mark Swilling. He will so he's with the National Planning Commission. He will do the first keynote. Then second, we have Aurora Akansha. She's the Director of Strategic Affairs for Multilateral Development Banks. She will do the second keynote. And then we will have Nazmira Mullah, who is the Chief Sustainability Officer with 91, as well as Catherine Stoduka, who is the Head of Sustainable Finance at Systemic. That will be the first panel. If I can just ask Nicola to introduce the second, and then I'll come back to the conversation.
Thank you very much, Zef, and good morning, everyone. I'm Nicolas Picchettino. I'm the Secretary General of IDFC, the International Development Finance Club. It's a club of 27 public development banks, and actually is the founding member of Finance in Common. You can see with 27, we can reach 536 now public development banks in this summit. And I'm really happy to be here with you, and we will be in the second panel discussing more broadly the relationships between the public development banks and the credit rating agencies. And for that, I am deeply honored to welcome Mr. Panayotis Gavras. He is the Head of Policy and Strategy at BSTDB, the Black Sea Trade Development Bank. We're going to have also Mr. Hamid Taufiki. He is the Deputy CEO of the CDG, Caisse des Dépôts et Gestion in Morocco. We're going to have Matt Robinson. He is Associate Managing Director of Moody's Rating. We're going to have Samira Mensa. She is Managing Director of Research and Analytics Africa at S&P Global. We're going to have Admasut Adese, President and CEO of Trade and Development Bank, and Ms. Samia Paiva, CEO of CAF.
Thank you so much, Nicola. So the first conversation is focusing strictly on this issue of capital allocation and sustainability regulation. I'd like to give the mic to Professor Swilling first, and then we'll come to you, Aurora. Thank you, Prof.
Thank you very much. What I'm going to share is work that we've been doing in the National Planning Commission, where I head up the Finance Task Team and the Infrastructure Task Team.
And sorry, Prof, you've got about 10 minutes.
Yeah.
I need to mention it.
Thank you. You can just put up the slides. So in the infrastructure tasking, we've done an analysis of the infrastructure requirements that need to be met going forward. And this is really using a gap analysis approach, the World Bank Beyond the Gap approach. But now that we've finished this work, it's pretty clear, following what Mariano Mazzucato said in the plenary this morning, that we're not going to address these challenges through a gap-filling approach. It has to be a transformative approach. So how do we do that? And after searching for quite some time on a framework that is premised on the assumption that fiscal and monetary policy is unlikely to change, we've adopted something called the monetary architecture approach, which essentially is premised on the assumption that a financial ecosystem is a web of interlocking balance sheets. In a credit-based system, everyone's asset is somebody's liability and vice versa, and if that's true, you should be able to map the financial ecosystem, which is what we have done in order to identify the balance sheet configurations that lock in a particular set of flows that are unsustainable, and what kind of balance sheet reconfigurations would be required to change the direction of capital flows, unlock new flows of capital in a way that could address our challenges without necessarily having to radically change fiscal and monetary policy. And those balance sheet reconfigurations that are possible, we call elasticity spaces. So this is basically our first step in the process was to map the balance sheets, and without going into the detail, this is the first mapping of South Africa's asset base, roughly 50 trillion. And the total requirements are roughly 10% of that asset base. And that provides us for a way forward for starting to map the relationships between the multiplicity of balance sheets that make up the South African financial ecosystem, in order to then start identifying some of the balance sheet reconfigurations which could unlock new capital. So one of the first things we did was to map the relationship between profitability and reinvestment in gross fixed capital formation. And as you can see from this slide, the profit levels are high in the South African context, but the levels of investment in gross fixed capital formation have consistently been below 15%. The National Development Plan target is 30% of GDP, is what we should be investing. But there's a big range. And what you see here is like communications is quite high in margins and also quite high in gross fixed capital formation. But if you look at the bottom, high margins in agriculture, but very low levels of reinvestment. And finance, which has become the dominant sector, is also very high margins. And it's not a particularly capital-intensive sector, of course, but the reinvestments are quite low. If you look at, if you remove banking and finance from the picture, and on the right-hand side, all the other sectors, what you can see is roughly between 150 and 200 billion rands worth of reinvestment per annum, which is roughly 10% growth over this time period. It should be 20 or 30% growth. And what that means is a lot of the reinvestment that is taking place in gross fixed capital formation is largely replacement rather than expansion. And that's a big part of the challenge we face. So what we have in the South African economy is very high market capitalization on the JSE, very profitable set of banks, and a high level of concentration of stocks and bonds in a very small number of households. Pension, some of the big trends since '94 is the massive growth in pension funds, as reflected in here, with relatively low levels of reinvestment in the real economy, and even less into infrastructure. This is a picture of the savings and savings investments funds, which are managed by the Association of Savings and Investment South Africa. You can see here's the picture of the sources of these funds and where they get placed. And not a lot of that money, unfortunately, gets recirculated within the financial system, which is part of the explanation for why we have quite a financialized economy. If you look at a rough breakdown of the financial sector, you can see that the banking sector is nearly equivalent to a GDP. The pensions is slightly less at 5.6, insurance at 4.2, and the shadow banking sector, which is the fastest growing sector, not surprisingly because there needs to be enablers of financial circulation, has been one of the fastest growing sectors. So the net result of this brief picture that I'm painting, it's a very large, nearly 300-page report, is reflected in this diagram, which shows the degree to which the financial sector has grown substantially and how you've seen a gradual decline in the other sectors over time. So one of the consequences of this financialization of the global economy, of the South African economy, is on the whole, general decline since 2007, 2008 of GDP, and that has resulted in a decline in core spending. At the same time, we have seen a beginnings of the rise in inflation, and this is a very dangerous situation, which opens up what we call the hippo mouth, which is this increasingly wide gap between the 10-year bond and the nominal GDP growth rate. And if we continue we continue along these lines, we are going to be facing a very serious financial crisis. And it's reflected in the fact that bank lending to the private sector has basically flatlined and is increasing to government. At the same time, government debt as a percentage of revenue is breaching the 20% mark. And if you put all of that together, as some of you well know, it's a disaster. But this has very serious implications for inequality. To just summarize the data that is now available over the last couple of years from researchers from University of Cape Town and Stellenbosch on the household assets. So we've always measured inequality in terms of Gini coefficient, but the real issue is household assets. And the wealth of roughly 0.1% is equal to twice the bottom 90%. So we have very extreme levels of inequality in a financializing economy with growing debt levels, and this kind of balance sheet configuration is basically unsustainable. However, what is not always recognized is the significance of the small business sector. There's roughly 1.5 million smaller informal businesses, which are mainly survivalist and don't really grow, and roughly 300,000 small formal businesses, which employ more people than the large business sector and contribute more to gross value add. But on the whole, the problem is that they have very limited access to finance. So if you want to address the poverty challenge in the South African context, the balance sheet reconfiguration that really matters is financial access for small formal businesses, which have got the greater potential of employing more people and contributing to gross value add. This is the story of the decline of the SOEs, which I'm not going to dwell on, but the summary of our current, if you like, economic and financial crisis is high profits, limited reinvestment, profitable stock exchange. Corporates have sourced more, the largest corporates are sourcing more of their capital internally but investing it internally. There's the growth in pension funds, which is related to the growth in the shadow banks without significant investment in the real economy. And we have real companies which are only 25% of the JSE that are sourcing capital locally, are investing locally, and are distributing dividends locally. Those are the companies that have got the greatest potential, together with the smaller businesses, if we want to address the inequality problem. So the core point of this whole analysis is to identify a set of elasticity spaces, which are things like, for example, moving the DFIs under the central bank so that they can access more ZAR in the capital markets. Pension funds, how a greater percentage of their investments can go into the real economy. SOEs, how we make equity investments from the fiscus conditional on fundamental reforms, especially at governance. How banks can become less oligopolistic and more open to accessing capital for small businesses. How we can focus attention on the real companies rather than the big companies that dominate the JSE but actually invest internationally. Shadow banks, how lots of skills, lots of agility, they can play a significant role if redirected. And households, instead of just focusing on poverty, focusing on wealth and the growth of the middle class. And then finally, blended finance solutions, particularly in our energy sector, where we are focusing on a massive grid transmission program which cannot be sustained off the balance sheet of the National Transmission Company on whose board I sit. We have to mobilize and connect to a whole range of other balance sheets in order to co-mobilize the capital that is required. So in sum, in our view, the infrastructure investment requirements are not going to be possible if we simply think in terms of filling gaps. We have to think in terms of how we transform the balance sheet configurations that were put in place after '94 and are not adequate for the tasks that we now face, especially if you take into account the just transition and the need to deal with inequalities. Thanks, Steve.
Thank you so much, Prof. And maybe for completeness, I must also declare that I was part of that study so that I don't have any comebacks. Aurora, can you please talk to us about how we should think about sustainability issues? Because we are trying to link that conversation you're going to give us with what the Prof has just said. Your mic, please.
Thank you so much. If I could get the slide deck displayed, that would be great. But I just want to start by first thanking everyone to be part of this summit and the organizing committee, AFD, AIIB, DBSA. I've attended so many of these summits over the years, and this is by far my favorite summit of all. It is absolutely well organized. The quality of presentations are amazing. And I think just the participation of people from the PDB community in one-stop shop, an event is just phenomenal. So Nicola, DBSA, ZEP, and AIIB, congratulations on an amazing, amazing event. With that, I will start my presentation. And let me set the stage. You might not have heard of International Sustainability Standards Board or the IFRS Foundation. Let me set the context on who we are, why we are here, and how our information can help you in unlocking capital. So IFRS Foundation was created 50 years ago with the intent of creating standardized accounting standards. Accounting standards were developed regionally by each country, and there was no comparability. There was no comparability for companies wanting to list beyond their domestic borders. So International Organization of Securities Commission, which regulates all the securities commission in the world, came to IFRS Foundation and said, can you solve the alphabet soup in accounting standards and create a global language that can allow companies to do raises beyond their domestic border? 20 years ago, IOSCO made that request from us, and we created international accounting standards, which I'm quite sure all of you here are familiar with, and your organizations report against that. So we exist to serve capital markets and allow smooth functioning of that and unlocking capital. So this is the structure of our foundation. It has two boards, the accounting and the sustainability board. The monitoring board is IOSCO, European Commission, US SEC, and other regulators. These are the two standards. But let me start with why we're here. So in 2015, when the Paris Agreement was signed, there was this huge intent to operationalize it beyond words. And how do you operationalize it? How do you use investments that should go into sustainable? You need a language to make that decision. So there were a plethora of frameworks and standards, GRI, TCFD, and the likes of those. And in 2021, the Financial Stability Board, G7, G20, IOSCO, came to IFRS and said, can you solve the alphabet soup in sustainable reporting like you did in accounting 20 years ago? So that led to the creation of IFRS Accounting International Sustainability Standards Board to develop standards that will provide decision-useful information to investors and cost-effective for companies. Companies who want to target investors who are keen to do sustainable investing have to report against their individual metric. So each company has 10 reports they had to produce, but now with having a global language endorsed by investors and the capital markets, this allows for easy reporting and easy decision making on both end, the investor and for the investee. Like any organization, when we were given this mandate, we didn't want to start from scratch. We absorbed the existing standards that were already in the market and developed over it. So the 4 legacy standards that are now IFRS sustainability standards are integrated reporting, SASB, CDSB, and TCFD. A lot of you would be familiar with TCFD, which has now retired. So FSB created that, and they have retired it last year and transferred all the responsibilities to IFRS Foundation. So with that, where are we today? We have released 2 standards in 2023. One is general sustainability requirements, the other are capital requirements. They have so far been adopted by following jurisdictions, and you'll see a mix of G20 members and non-G20 members in here. Together, these account for 40% of market capitalization, and if you exclude US, it's 80% of market capitalization. So what we are seeing is how everyone is keen to standardize the process for reporting that would enable unlocking capital. And I would just step back for 1 second and go to the big theme that I've heard at various presentations throughout these last few days is there is a demand for financing for infrastructure and various other causes, and there is a supply gap. And there's a supply gap for various reasons. One of those reasons is the cost of capital being too high and lack of information for investors. IFRS sustainability standards are that bridge that have standardized disclosures on strategy, risk and metrics, targets, and risk management that can enable a company to provide the relevant information to investors to unlock capital and reduce the cost of capital. So that's the bridge that we help in bridging the supply and demand gap. What makes us the global baseline for sustainability disclosures is endorsement by IOSCO, which is the Securities Exchange Commission. The standards are auditable. One thing that if anyone here is an investor or an analyst, you struggle is when a company provides you information, you have to double and triple check because there's no assurance attached to it. So you know you have to do your due diligence. These standards come with an assurance built in, and that could really enhance the quality of information and the trust that investor has. They're being adopted by jurisdictions at a regulator level where it's mandatory, and by market participants in a voluntary basis. With that, I'll say investors like BlackRock, Vanguard, Norges have included ISSB standards in their proxy guidelines, and Nesmira from 91 is here, who's also part of our investor advisory group with various other investors who have committed to using ISSB standards in their decision-making as appropriate. I will end by saying the alphabet soup that existed in sustainability reporting hasn't entirely been solved. There still are various other frameworks beyond us, and one of our mission is to make sure that we are interoperable with them. So these are the partnerships that we have to ensure that our standards can be aligned with the companies who are using these other ones. CDP, GHG Protocol, GRI, TPD, Transition Planning Task Force from the UK is now part of IFRS, and TNFD. I will say, so one more thing I'd like to say is the desire for carbon markets. Another theme that I've heard during the last few days is carbon markets. Carbon markets require disclosures of Scope 3 emissions. Our standards mandate Scope 3 disclosures. We understand that it's not possible in the first year or the first few years for a company, which is why there are transition reliefs and proportionality built into the standard. But the ambition is to get to Scope 3 so you can create all the markets that can come with it. With that, that is the end of my presentation, and thank you again for the opportunity to present.
Okay. Okay, thank you so much, Aurora. I want to turn to you now, Nazmira and Catherine. Can you please help us understand how do we put the two things together now? We've heard about the capital allocation on the one hand. We've heard about the sustainability regulation on the other. How do we make sense? Let's start with you, Nazmira. 5 minutes, your thoughts.
Thank you, Zeph. Let's issue the most challenging task of the week on Friday. Put two very different things together. Look, I think at first glance they seem quite separate, but actually what both of them are coming to is how do you get more money into real investments that shift the dial? And the solution has to be increasing.
Can you just pull your mic closer to you a little bit?
Yes, I put my mic closer
Thank you.
to me. There we go. Is that better? Okay, fantastic. Apologies for that. So I think what I started with was just acknowledging that at first glance these two topics seem quite separate. And just for the record, Catherine and I were not given the presentations ahead of time. So the remarks are developed. I feel like I'm back in high school debating here. But I think the topics actually both come to the same thing. How do we get more money flowing into areas that move the dial, that actually have real impact on the ground? And Mark starts off talking about how do we actually fund infrastructure in South Africa. Let me start with the ISSB, because I think the reason we are a supporter of the ISSB is the recognition of a need for common standards and a common language. And as both a listed company, 91 is listed, and as a investor in 30-odd markets across the globe, we have struggled on both ends with the very many reporting frameworks, concepts that have been developed around sustainability. There's a whole lot of cottage industries that have been developed, which makes it very hard. There's an enormous burden placed on companies to actually report against these things, which we are very hopeful the ISSB is going to alleviate. One of the reasons I have been very encouraging of the JSE to adopt ISSB is that, yes, we understand that there's some extra things that perhaps in South Africa we'd like to have, but having a common understanding for investors in the country of what reporting they're getting is more valuable than the extra 3 data points the JSE would like. And so we've been very critical of the idea that they adopt an alternative. Rather, they should base it on what the ISSB is doing, because that is more valuable. So that's one element. Common standards, common language. And we translate this from the likes of the ISSB to the launch of the Fast Infra label. And why I think these sort of standards are important is it starts to provide investors in different parts of the world with that understanding that Aurora was talking about. This is what we're getting. If we invest in an infrastructure project in Vietnam, it meets these standards if it has the Fast Infra label. If we finance a renewable energy project in South Africa, same thing. Which means if we're running a global emerging markets infrastructure fund and we have 40 assets in there, all with the label, it's a little bit like having credit ratings for sustainability disclosures. So that's what we are very encouraging of, standardization in terms of disclosure, standardization in terms of labeling. And what this then brings us to is where Mark started. How do we get more capital into financing infrastructure and financing infrastructure in South Africa? Well, the first element is we all agree what good looks like, and we have a common understanding there. The second is I would have a slightly different diagnosis to the low growth rates in South Africa than was offered earlier, is I think it is entirely due to poor government policy over the course of the last 15 years. And actually what's happened on the JSE over the last 5 years is profitability has declined quite considerably across all the local areas of the economy because growth's been weak. The JSE is a reflection of the JSE is simply a reflection of the economy, except for those companies, like commodity companies, which sell their product offshore. So what do we have from the pots of capital in South Africa? We have pension funds that are increasingly exporting large amounts of their capital because there has not been growth in the local economy. So the JSE has shrunk considerably as a percentage of other stock market capitalizations, so relative basis. In 2005, the JSE was 13% of MSCI Emerging Markets Index. Now it's about 3%. And that's a reflection of what's happened. In the meantime, you have South African pension funds that are actively looking to allocate to infrastructure. We've launched a South African infrastructure fund where we are actually seeing pension funds allocate into. The challenge they face is, given the poor economic growth, there's a real concern that their membership is shrinking, and therefore their ability to allocate into long-dated assets is constrained. So we need to do two things. Well, one, we need to get growth going so they stop worrying about that and actually can invest in the real economy. Secondly, is we need to solve that liquidity issue. So Mark and I were talking earlier about efforts to create structures that provide effectively securitization structures with liquidity that will allow the big balanced capital pools in South Africa to invest in local infrastructure. That is a solution.
Okay.
And am I over time? I was following the counter.
No, don't be fooled, but this clock is not starting when
I mustn't be fooled by the counter. Okay, apologies.
It's not starting when I want it to start, so.
Okay, I apologize if I was just working to time on the counter.
It's 100%. I want to move to you, Catherine. Your thoughts, please. And can my time start when I need it?
I'll be quick, Zeph, I promise. So firstly, I just wanted to say, again, echo my thanks for the incredible convening, the talent and expertise in this room, as well as the commitment to partnership and collaboration. I think we know that we are in a world and a time where that collaboration is more important than ever. So huge congratulations to colleagues who've been resilient in the G20 discussions as well. We know that these are difficult times, and it's where this community is more important than ever. It is also something that I think we need to acknowledge, that we live in a time where sustainability has gone from being a buzzword to a dirty word, potentially. And if we don't name that, then we're having this conversation, as Mark and Naz were talking about, allocating capital to the real economy, to resilient, sustainable infrastructure. And we're talking about sustainability standards, as Aurora described, without naming the beast. And the beast is, there is more green hushing going on than ever before. Naming the beast is that we are seeing funds change their names from climate funds to accelerator funds or, geographically linked funds, but they are wiping green, climate, sustainability out of even the labeling of products. And so I think let's just hold that for a moment and say, when we're having conversations with national development banks, with asset managers like 91, with pension funds who clearly need to deploy their patient capital into the infrastructure which will build economies, drive growth, accelerate climate action, we're in a time where the technology has never been better. Solar and wind technologies have never been cheaper, but the politics have never been harder. And if we hold that, then I think we can be honest amongst ourselves, maybe provocative amongst ourselves, about the link between these two incredible presentations, thank you both, Prof and Aurora, and say we've got a growth challenge, an investment opportunity, a need to deploy more capital into the real economy. We've got a bunch of confusion from investors who don't know how to evaluate whether sustainability is real or not, who don't know how to evaluate whether they will be penalized or promoted for using language like clean and sustainability in their investment communications. And that makes this conversation even more important. So what should public development banks, DFIs, MDBs do? What can they do to reduce some of the confusion, to ensure that we don't see such a backlash against the sustainability agenda that people just put their heads in the sand? And I think they can do three things, and they speak a little bit to Mark's possible elasticity spaces. They speak a little bit to Nazmira's points about engaging with some of those long-dated capital providers, and they speak to Aurora's points around a common language to communicate with investors. And I think the first thing that public development banks can do is be courageous in talking about their success stories. We know that development banks are often at the forefront of coming into highly impactful climate resilient infrastructure, and these are organizations, you are organizations which are tracking intensely the impact of the work that you do, the impact per dollar, the outcomes that you're seeing, and being clearer in forums like this, but also in forums outside of this echo chamber about what your investments are delivering. Not only on a sustainability track, but also in terms of returns and, frankly, in terms of low default rates and performance. That is going to help give confidence alongside things like the standards that Aurora has been describing. I think the second thing that public development banks can do is take inspiration maybe from the ISSB in terms of standardization and collaboration, because one of the frustrating things, I think, Naz, as you described, as an investor, is that you are often being pitched multiple different standards, forms of communication, or ways of interpreting impact and outcomes. If the PDBs are working together as a system, as we know Finance in Common is really trying to achieve, then there is an opportunity to reduce the transaction costs of the interface with investors, including those pension funds that Mark mentioned, where we need to accelerate and increase to 20%, I think you said, investments into infrastructure. And the final thing, because I know I'm over time, Zeph, is that The PDBs can work closely with the private sector, with academia, with standards groups, in terms of how they engage with governments. We are seeing fear, pushback, worry about putting sustainability, climate, and solidarity into public multilateral decision-making fora. But there's safety in numbers, there's power in numbers, and there's evidence in the transactions that you're all doing. And so ensuring that the themes of G20, solidarity and equality, are also linking to the sustainability agenda rather than having that, under the carpet, I think is going to strengthen spaces like this and make sure that the green bit is not weaponized. It's standardized, as we've heard from Aurora, but it is also put in the context of investment needs. This is not an ideology. Green is not an ideology. It's a way to drive the growth that Naz was talking about. It's a way to create the jobs that we've been discussing this entire week. And it's a way to hopefully generate more sustainable trade, multilateral relationships, and opportunities across the continent and around the world. And that's where PDBs can really also be a driving force. Thanks, Zeph.
Okay, thank you so much. I'm not going to have time to take questions, so what I will do instead, I will ask for words of wisdom from each of you. So I'm going to give a minute each. What is it that we must take away from what you've said? If there's one thing we must remember, what is it? Start with you, Prof, and we'll work our way down. 1 minute each.
Well, I think Nazmira and I agree that the challenge is mobilizing investments in infrastructure, but where we disagree is why there's been consistent low levels of investment in gross fixed capital formation since '94. I don't agree with the statement that it's entirely due to poor governance. I think the private sector needs to take responsibility, not just within South Africa. This is a global phenomenon. I was in Colombia last week working with government on their Just Transition country platform. They face very similar challenges. What the president might overstate the case by calling it a capital strike, but the reconfiguration of our financial system is absolutely key if we're interested in these transitions.
Thank you. Aurora?
Thanks so much. I think in 60 seconds, I would probably summarize that the problem statement identified by the professor and Naz explaining her struggle, and when you're trying to make informed decision in different markets, there's a common language needed, which is one part of the solution, ISSB. I want to build on what Catherine was saying on how everyone in this room can work together and just highlight how we're working with PDBs and MDBs. So the World Bank, EBRD, AIIB have publicly announced their decision to adopt ISSB standards for their own reporting, which we then hope would translate into them using the standard as an investor. I invite everyone in this room to consider ISSB standards for their own adoption and use, and we work with MDBs to support their clients' countries in adopting the standards or the preparer community in capacity building. It's a new language. I won't deny there's a cost involved in adopting the standard, and PDBs can play a critical role in reducing that cost by offering capacity building. Thank you.
Okay, thank you. Nazmira?
I think, as Mark said, we all in agreement there's a funding deficit. And I'm sure there are many things, actually I know there are many areas where the perception of risk from private sector investors is inappropriate. But the question for me is, how do we overcome that? And the first is standardization of reporting standards as much as possible. The second is problem solving. So understand what their issues are and let's solve for them, whether that's liquidity issues in the SA market, whether that's this perception of risk from developed market asset owners in terms of investing into emerging market projects. Let's find a way to do that. And what would be very helpful in doing that is coherency from the development banks as much as possible. So Catherine summed it up so well when she said, the more that you, this very powerful lever that the people in this room offer to the financial system can work together, the more that we can achieve. Because I worry that there is no other lever that's going to offer it at this point in time.
Okay, thank you. Catherine?
So if you asked for wisdom, I'll just give you some numbers instead. So I agree, we can't talk about this as a funding gap. It's an investment opportunity. $2.3 trillion in emerging markets and developing economies, excluding China. That's the size of the investment opportunity. 60% of the clean energy generation capacity in the next 10 years will be in emerging markets and developing economies, excluding China. That's a big investment opportunity. Second, let's not weaponize sustainability because it is an opportunity. So we can use standards and some of that communication that Naz was just talking about to make this about the upside, the investment opportunity, rather than an ideology. And thirdly, the tools are in this room. If I look around this room, I can see lots of friends. I can see Junaid over there from MEGA. I can see Anne-Marie from FSD Africa Investments. I can see Ekaswehi from the Insurance Development Forum. I think Rua from the Quadrature Climate Foundation is somewhere in the room. You have the entire capital stack here with different solutions, ways to risk manage, ways to reduce that perception of risk, ways to partner. There's no innovation needed. The solutions are in this room. We can meet the investment opportunity. We can avoid weaponizing sustainability, and the power's right here.
Okay, thank you so much. Can you help me thank my panel, please? You did great. We are 3 minutes late, so that's... Thank you so much.
That's fairly manageable. Thank you. Thank you very much, Zef, and thank you to the first panel. It was a very interesting discussion on capital allocation and sustainability regulation. Now we're going to dive in the relationships between PDBs and credit rating agencies. All of this linked, or you know, about the cost of capital and the need to reduce this cost of capital, especially in the developing countries where the needs are huge. And I'm really happy to have around the table PDBs, regional development banks, national development banks, but also credit rating agencies. This is really the system we want to create within finance in common. And you have seen that the S evolved from summit to system to include as many partners as possible. And you are right, Catherine. I deeply believe the solutions are in the room, and we are trying to find some of them during the panel. Just to say also that IDFC are starting discussions with the credit rating agency. We created a dedicated sub-working group led by some of my fellow panelists here. And not to be too long, we're going to address what are the key challenges and opportunities in how credit rating agencies assess public development banks and how can the relationship be improved. And to start the panel, I'm going to turn myself toward Hamid Taufiki. You are the Deputy CEO of CDG, and could you elaborate on the fact that FIX has provided us an opportunity to focus on this topic? How can this dialogue go forward, and what other forums may help such a process? Or what sort of initiative concerning the credit rating agencies would you like to see? Please, Hamid, the floor is yours.
Thank you. I think the question on how can this dialogue go forward, I think it's important to ask ourselves why, in fact, this topic is important. We usually, you mentioned the IDFC club, where we had, in fact, developed a lot of subject, and we reflect mainly on the asset side of our activity, i.e. the type of sector, the taxonomy, and so forth. And we end up with this subject, in fact, of the resources, how to increase, in fact, the resources. We are here within the FIX, the same situation, i.e. we focus, which is very important, on dealing with various sectors, various methodology, taxonomy, and so forth. And we end up with the situation that the need are very, very important and the investment are huge, and we need to increase the resources of the various PDBs. And when you look at it, and for every country to finance really the economy, it's not sufficient, in fact, to rely only on the credit institution, because we need to develop capital market to be able to finance correctly, in fact, the economy. And this is exactly the situation for the NDB. What we have situation today is we have this paid-in capital for each NDB, which is limited with the resources that have from the government or for other partners, international partners. And some of them, they do have, for example, private deposit in their balance sheet. This is the case of the Caisse de dépôt, for instance. But I think to do more, it is important that they have access to the capital market. But the capital market, you have twofold. You have the international capital market, but you have also the national capital market. And I think to be sustainable, I mean, the climate finance, the development finance, to be sustainable, it has to be rooted locally. And that's why I believe, and we believe, that if we want to finance and be able, in fact, to cover the various issues, we, as an NDB, we have to play an important role in developing the local capital market. This being said, what we have today is for NDB the possibility to access the capital market for international capital market. To do so, I think it is critical that we have this kind of interaction with this with the credit rating, because this is the credit market is something where you have to be, as an NDB, to explain exactly how it works, how your process, how your risk management is developed and reinforced. But on the other hand, we have also to bear in mind that the NDB are not commercial banks, so they are very specific, and you have to explain and describe clearly, in fact, the mandate that you have, the relation that you have it with the government, and also make sure that we can build something in terms of methodology that is adapted, in fact, to this type of vehicle. We did, for example, with regard to we are regulated, so the majority of NDB, normally they are regulated, so they are dealing with their central bank. So the criteria that central bank use for commercial bank, some majority of countries, they apply the same thing for NDBs. But we, in Morocco, for example, and for the Caisse de dépôt, we were able, in fact, to develop an interaction with the central bank and to develop something which is really taking into account the specificity of our activity, the fact that we do the credit, long-term credit, the fact that we have a mission to be contra-cyclical. So this something has to be taken into account, in fact, and adapt. So we believe that this can be the same case. That's why we do need to have this kind of dialogue between the NDBs and the CRR.
Thanks a lot, Hamid. You highlighted indeed the specificities that needs to be recognized by the credit rating agencies. I'm sure my fellow panelists representing those CRAs will be very happy to answer. But before giving them the floor, I want to turn myself towards Panayotis Gavras from the BSTDB. You are a huge supporter of this topic, and you pushed a lot for a better discussion, better integration of dialogue between the PDBs and the credit rating agencies. Could you tell us what new tools do we have available or under research that could help update the CRA's methodologies and maybe make some propositions?
Thank you, Nicolas, and thank you, Hamid, for a very good opening to this very important panel. Let me also repeat what others said earlier about the excellent organization of this conference and the very high level of dialogue and the wonderful discussions we've heard. I hope this panel contributes to that as well. I hear, and I think we can even say, carrying over from one of the panels we had yesterday afternoon, where credit rating agencies were involved and where the issue was discussed, and there were talks about them changing and all of that, and the call for change that we heard from Hamid as well. I think this system, the existing system, is ripe for specific important improvements as to how credit rating agencies rate multilateral development banks and the emerging markets in which they operate, and I think that's an important element to keep in mind. There are two elements to this. There's the sovereigns, the countries in which development banks, multilateral development banks, and national development banks operate. It's generally in emerging markets, either public or private. And then there's the rating of the development institutions themselves, with the multilateral development banks comprising a separate class according to Basel, and also according to the methodologies of the rating agencies. There are a number of issues. Some of my colleagues here will, I think, expound on them a little bit more. But for example, there's the question of the risk weights in emerging markets. There's the question of the preferred creditor status that multilateral development banks have. The very important issue of callable capital, which has been very, very prominent in G20 meetings in recent years. There's been a lot of work done on that. There are also other issues such as concentration ratios, which rating agencies have applied to development banks and which is quite a controversial area, and also ESG, where certain measures have been created where there's still some lack of understanding, perhaps, or even confusion, you could call it. Let me say, as I turn my focus more to the tools, that first of all, I'm a very strong proponent of the need to migrate towards the original goal that rating agencies have, and that's the focus on creditworthiness, not other elements of policy relevance and impact that they sometimes bring in. And there are two reasons for this. One, policy relevance is a very subjective thing. Whether you're doing or not doing your job is something that can be assessed in many different ways. And sometimes, for instance, the rating agencies may look at it very differently than the way our shareholders look at it, either for better or for worse. But it is a subjective element, and the measures there that they have developed are not always very convincing and not always very well understood. Creditworthiness is something that is much more measured, and now I'm turning to my second reason why. And there is also another, there is a self-serving reason for saying this. No multilateral development bank has ever defaulted, nor has it even called its callable capital, which is a form of guarantee, as you're probably aware, most of you, that is provided by their shareholders in the event that they ever encounter distress. So they haven't even reached the stage where they're in a distressful enough situation where they would call the callable capital. The tools that we have now, and this is where I want to really focus the discussion a little bit, the most powerful, and there was mention of it in some earlier sessions as well, is the Global Emerging Markets Database. This is a very exciting initiative that has come up in recent years. It measures in emerging markets expected default rates and loss given default, and it has significant implications for how we look at risk in emerging markets, both sovereign risk and in the private sector. It has many implications. I should say it's a work in progress. It's constantly being developed, built upon, granularized, if that's a word, and made more specific. And this is an extremely positive development which will allow us on issues such as preferred creditor status, where there's a lot of work already taking place to see how exactly to measure it. That's a long-standing issue which has been going back and forth between the rating agencies and the development institutions. And now we do have tools which will help us to do a much better job than in the past, where the rating agencies have tried, but they've generally relied on proxies, substitutes, rules of thumb, which are not entirely bad, but these are much better, and I think we need to migrate to those. In addition, GEMS has implications for provisions, which is not directly perhaps linked to rating agencies, but it also has huge implications for risk weights and the risk weighting of assets in emerging markets as we go forward. And really, as it develops and it grows richer and incorporates more data, I think we'll be able to really get to a much more detailed, specific, granular level on that. There are other initiatives going on too, not just GEMS. I came across recently an article about some fascinating work being done in Edinburgh about ESG and how that's being used to assess climate impact on sovereign ratings and integrating climate risk into financial frameworks. I don't know it well enough to speak at length here, but it's very exciting what they're doing. They're using also the kind of things, the tools that we do have at our disposal now, big data and artificial intelligence, in order to simulate these situations and get to a more granular level. And also with callable capital, there's a lot of work that's been going on at academic level within the multilateral development banks. And as we go forward, I hope, technically I'm very optimistic. Let me close with that. Technically, I'm very optimistic that these ongoing processes and these new tools that we have will allow us to go forward. Politically, I'm a little bit more cautious. And I'm going to close with that because the politics is always an important element, and I'll let others talk about that as well. Thank you.
Thank you very much, Panos. And indeed, GEMS is an impressive database. We have 11,000 projects disclosed by 26 members. It's not enough, of course, and this is one thing we are trying to push within the club, having more public development banks declaring their data. But so far, the GEMS database, it proves that investing with the public development banks is less risky than investing with other investors. So do count on us to continue. And thank you for this. Now it's time to turn myself towards our friends of the credit rating agency, starting by Matt. I want to ask you the questions. What are the CRAs doing these days with respect to their assessments of public development bank, both national and multilateral? Should we be looking forward to anything new or innovative in the future?
Thank you, Nicola, for such a good question. And let me reiterate what my other panelists have said about the FIX Summit and what a privilege it is to have the opportunity to engage here. Moody's rates about 120 public development banks, about 90% of the sector by asset. And the two things that I wanted to talk about to answer your question, one is a research paper that we published earlier this week and a discussion paper last year on the evolving developments in the sector. The research paper that we published was deliberately titled Mandate and Support, Key to Public Development Bank's Future Climate and Development Financing Role, to get to the BSTDB's point about the mandate being something that underpins the creditworthiness of the institutions and their ability to deliver. That research report recognized that these public development banks have large resources, they have the tools, they have the local knowledge. It's critical to mobilizing private capital for climate and development purposes. Obviously, those with lower leverage, with better loan quality, stronger liquidity buffers are better positioned to scale that up, but they all have a role. And then finally, and this is perhaps the more important one, the extent to which many are exploring innovative instruments and other forms of risk sharing in order to achieve their outcomes. And that's where the discussion paper that we released last year, August last year, it comes in, where we were exploring the evolution in the sector and seeking market feedback on how it's been evolving. There's 5 key parts to it. The first is the increasing sophistication of the capital structure, portfolio guarantees, hybrids, securitization, all designed to enhance loss absorption capacity, and we're recognizing that would allow more lending. The second is the increasing focus on the use of credit enhancements to boost the loan portfolio performance or the quality of the loan portfolio. You think about collateralization, you think about political risk insurance policies, the third-party guarantees, credit default swaps, asset securitization. The third part that we've been focused on is the new data that's available, both our proprietary data and also the GEMS data, but what we get from the other development banks as well in terms of calibrating preferred creditor status. We know it exists. The GEMS data supports what our proprietary data says, and that is a lower probability of default and higher recovery rates in the event of default. But arguably it's a spectrum. PCS is a spectrum where it's not a binary, you have it or you don't. Certain institutions very much benefit from it. Other institutions under other circumstances may not have quite the same strength of their PCS. The fourth point is about the impact of callable capital, where and how that should be factored into some of our metrics. And that gets, I guess, to the risk-weighted asset point. Yes, it's more precise, asset-by-asset breakdown, enhanced comparability, allows for precise modelling, but it is in practice, very cumbersome. It's resource intensive. We, as the credit rating agencies, need to validate the risk weightings that the institutions use and to ensure that we've got consistency. So it's not just on us, the imposition, it's also the imposition on the issuers as well. So we need to work out the cost benefit from heading down that path. And then finally, the additional mandates that MDBs are taking on, whether it be in the climate space, whether it be in other forms of social or sustainability space, and whether that represents a risk to their portfolio or whether it represents something that underscores or underpins their mandate and really builds on that shareholder support. So the discussion paper that we published, it was a first step towards considering whether we update our methodology, which I think is what your question is absolutely getting at. The next steps, we're incorporating that feedback into our analytical thinking to see whether or not a methodology update is warranted. And if so, if we were to head down that path, we would publish a request for comment. We would seek market feedback on any proposals that we're going to make before adoption. I guess the point that I wanted to make is that it will be very much in the public domain. You will know about it as and when it occurs. Finally, what else are we doing to try and enhance transparency and the understanding of credit ratings? All of our rating actions are public. All of our methodologies are public. We produce research to support our views on creditworthiness so that investors can understand why we've assigned the rating that we have. But perhaps most importantly, and this is a point that I made to TDB and CAF a little bit earlier today, we make the effort to transparently present to the multilateral development banks our assessment and allow them the opportunity to scrutinise our assessment and challenge us on our key assumptions and the way that we're looking at the points. So we don't expect everyone to always agree with us, but at least understand why we've come to the point that we have, and so that we can all have an educated, informed debate and ultimately serve the investors that are the ones that are being asked to put their hands in the pocket for a lot of these development and climate activities.
Thanks a lot, Matt. You touched a lot of points. We heard about credit enhancement, and Junaid will be named a second time because we have Miga here, and we count on you. A lot of innovation. Also, just to mention that within the finance and command systems, there is an innovation lab that wants to focus specifically on this. You name also the preferred creditor statute. I'm sure my panelist Almaso will want to react to that just after I give the floor to Samira Mensah. I want to ask you the question, what about CRA's assessments of the emerging market in which development banks operate? Is there anything you can say, anything new here?
Yes, thank you very much, Nicolas. This has been a great discussion. I certainly share the views that my co-panelists have outlined thus far. Similarly to what Matt has said, we look at market development to essentially adapt and cater for these changes to make sure that our ratings are fit for purpose. This is an expression that has been used actually over the past few days quite a few times. And one of the latest developments, and I was on this panel yesterday about these deferral clauses related to climate resilient deferral clauses. In December 2024, actually, we have changed our rating definitions to essentially cater for sovereigns, low-income and middle-income countries to suspend payment, to trigger CRDCs in case of a climate event. So there are some conditions, for this to work out around, of course, the definition of a climate event that is independently approved by an authority to say that, it meets some sort of trigger, that the interest payments on these obligations are essentially, yes, suspended, but accrued. So the net present value of the financial obligation is not impaired. And more importantly, that there is no arbitrage from an issuer to essentially say, I'm going to suspend the payment on a given debt and pay another one. So, and if all these conditions are met, for instance, then there's no default triggered. So this is like a concrete, really, development that happened really recently. Very few sovereigns have invoked the CRDC clause, for instance. Small islands have done so. But we understand clearly that not only MDBs are pushing and expanding, scaling up the use of these CRDCs, but also commercial banks. And then the next step is probably just the adoption from the capital markets, so private creditors. So this is one development. The GEMS, that famous database that is being developed, it is certainly a welcoming and a welcome development, rather, because yes, it does actually provide data. So intelligence, especially across the continent and emerging markets at large, is something that is almost like gold, and it's important to make sure that we are always updating, the data that allows us to compute, these risk-weighted assets and capital of MDBs and PDBs, to just echo what my co-panelist Pana mentioned. And yes, indeed, if these PDs and LGDs are essentially better, yes, ultimately it will result in lower risk-weighted assets and so greater capitalization and standalone credit profile of how we look at these institutions. So it's certainly very important, knowing that, of course, it's number one in development, number two, it is sort of skewed towards data stemming from institutions that have a preferred creditor status, that PCT, and potentially, some concentration aspects around their exposures, generally speaking, because, just as a reminder, MLIs tend to lend to sovereigns. 2/3 of their balance sheets are skewed towards sovereigns, 1/3 to the private sector. That private sector tend to be a tier 1 sector. So yes, but it is important. Certainly, we are trying to be constructive there, and it is helpful in the discussion around infrastructure developments, because the CLOs, the collateralized loan obligations, do need actually additional data, and certainly these GEMS and other data developed by AFD and INSEE will be extremely helpful. Let me stop there.
Of course, thank you. Thank you very much, and thank you for being cautious of the time. Two reaction maybe on the CRDC. We did not prepare it, but I want to extend the invitation. Within the Fix Innovation Lab, we have a dedicated working group on CRDC, so why not welcoming also the credit rating agencies with us? It's really making the system. And on James, of course, cannot agree more. We need more data, of course, but I really believe it's a beginning of something that will improve the credits rating of the public development banks. I'm now turning myself toward Admasu. Admasu, I'm sure you want to react to a lot of the things that were discussed already, but let me ask you a question. Looking ahead, what key adjustments or innovation in the credit rating agency methodology would be most beneficial for the multilateral development banks, but also for the national development banks to enhance their financial capacity while maintaining strong credit quality, because we know it's key also?
Thank you very much, moderator. I'm very also pleased to be here, like my colleagues have mentioned. And just to echo, this is perhaps one of the best finance in common editions we've had in 5 years. This particular meeting is testimony to that. I don't think I've ever had an occasion to have this kind of rich interaction with very important actors in the world of PDBs. So thanks to the ratings agencies as well. I think there could be one or two other actors, but I'll share that with you afterwards. Very quickly, it helps to be the last person speaking, because you can just be very selective, or maybe there is one more person next to last. Just to say a couple of comments around improvements, but just at the outset to say, we've actually had some very good engagements over the years with ratings agencies, not on just usual normal business, but how best to innovate, how to reform, and how some of those reforms might factor into the treatment that they would give us on the ratings. And of course, Moody's is around the table here, so we've enjoyed that kind of very constructive ex-ante engagement before we actually do it, so that we ensure we get the right treatments. And so it has been a very positive journey for us. But of course, as we know, we live in the real world. It's a mixed picture. Sometimes there are areas that you think are not getting enough consideration. One area that came up also in the G20 discussion on MDBs and callable capital, there was always a big debate as to whether that's being factored enough in methodologies. I mean, it is given some consideration, I know, but I think it can be much better. I think there is growing convergence and consensus that the big capital that's not on the balance sheet should be somehow recognized. And in fact, we had gone an additional mile to strengthen the actual profile of that callable capital, because we are an MDB from the South, and our sovereign sponsors are typically not AAA rated, so we had to do some innovation to credit enhance that callable capital. And I'm very pleased that at least with Moody's we got somewhere, and they did give us good recognition, not just because Matt is here, but it's there in the reports. But not all the ratings agencies that we deal with have given adequate recognition to that, and I think all of them can perhaps do better, because it's very large, right? Callable capital for us is 80% of subscribed capital, and so I think there's just so much more room there to do better. I think another area is, the question of where one sources liquidity from. It comes up in ratings, and we do know that capital markets are a very important source, but you do have cycles that come and go, and sometimes capital markets are not a good source to tap, because the numbers go out and you get strange risk perceptions, and just cost factors just completely become unreasonable. So when you divert to other sources of liquidity, sometimes rating agencies don't give it enough consideration. Their feeling is you're moving away from capital markets, you don't have access to capital markets. It's not just a question of access, it's a question of cost. And as PDBs, one of the reasons we exist is to intermediate affordable long-term finance. And so avoiding very expensive credit, it should be a good thing. But we are actually penalized for that. So I think that's another area. Alternative sources of liquidity should be better recognized. And then, of course, credit enhancement. Again, I think it has been discussed. But again, I think sometimes there can be a bit of a narrow perception around how you treat credit enhancement. In many cases, you do take credit enhancement as capital relief, as a last resort measure. And before you get to that last resort, you're engaging. You're trying to work things out so that you don't actually trigger that last resort. But in the process of doing that, sometimes there's a sense of impatience that you should behave like a commercial bank and immediately trigger those last resorts. And there isn't enough appreciation that systemically it's important not to go that last step unless you absolutely have to. And I think this is where there has been, again, a sense of disappointment on our part. Some ratings agencies have almost said, if you don't call some of this credit enhancement or if you don't crystallize it, we're going to start saying it's invisible, it doesn't exist. Maybe there's a reason why you're not. I think there's a problem there. And I think beyond ratings agencies, I think part of the improvements and the enhancements we can be considering here is also to what extent the PDB community as a whole and important stakeholders, not just ratings agencies, the IMFs of this world, the Paris clubs of this world, how do they also factor in important considerations like, for instance, the Bridgetown Initiative that has now finally gotten somewhere in the global MDB, the Tier 1, the AAA MDBs have finally, moved the needle on how you give special consideration to climate shocks. And if a country goes through a climate shock, if it's an island country that is very vulnerable, you take special steps to give breathing room, and that has been finally agreed at some level, but it's not widely agreed across the PDB industry. And so we sometimes play the role of a last resort trade financier or near last resort trade financier alongside central banks. And when these shocks come and you take that into consideration, some stakeholders don't give you enough recognition that it's important to do that. And so maybe this is beyond ratings agencies, but it's also an important issue, especially in the context of trade finance, because trade finance is quite sensitive also to these factors. PCS has been discussed, but just one other point on PCS. It is a spectrum, as Matt has referred to, and that even that point is not adequately appreciated. It is sometimes treated as a binary matter. Either you have it or you don't. But the truth is, it is probably a spectrum. But in the understanding of that spectrum, I think there's not enough consideration to those PDBs who deal with fragile economies, right? Because we know that we live in a world where last mile impact has a special place in the world of development. It should be given much better weight and better recognition. We've had an excellent relationship with some institutions who in the past wouldn't work with us, but in the context of fragile economies, they've stepped up and have agreed that special measures are required there. So I think PCS should also have that lens to look at those who are going into the most difficult jurisdictions to do the things that even many PDBs won't. You go into those jurisdictions, and then when the PCS discussion is on the table, that spectrum point comes and they say, oh, it's not a question of how heavy the lifting is, it's a question of who your shareholders are. So if you have the right shareholders, you get all the ticks in the box. But they're sometimes not the ones going into the most hardest areas doing the last mile work, but you don't get any consideration for that. And I think that's an area that is, I think a sore point for some of us. But I should give credit to MIGA of the World Bank. I know Junaid is here, but so is the European Investment Bank. They've worked very well with us. And this is about really going beyond the rhetoric, following through on the rhetoric and doing the things. Yeah. If there's time, I'll add to this, but
I'm sorry, I'm cautious. I want to give enough space to my last panelist, but thank you very much, Masu, and take into account that it's the third time that Junaid is named. Next time you're going to be at this table, Junaid, for sure. And thank you very much. And if I summarize in one word, we need to differentiate maybe the public development banks from the commercial banks. We have a specific mandate, so it needs to be taken into account, even if I also recognize that credit is super important. Samia, now, last but not least, I want you to ask the question, can you share a concrete example of how these advances in CRA's methodologies have already benefited to CAF? Conversely, what limitations still impact the bank's sustainable growth? Can you elaborate on that, please?
Thank you. Thank you very much for inviting us for this excellent panel, and thank you for my friends here. I would like to start recognizing that since this conversation officially started between the credit rating agencies and MDBs in 2023, I think that there were many positive developments. We have to recognize this. There is much more clarity on the key pain points on the CRA methodologies, but there is also more openness, transparency, engagement, and I think that is really positive. This is what I called the qualitative improvements. However, in terms of the quantitative aspects of changing the methodology, we still need to see concrete changes. So Fitch, that is not here, recently also released its new methodology with small but important steps, positive steps. I can mention concretely the reduction in the penalization of the hybrid instruments. This, of course, will help us, multilaterals, to issue those bonds with a lower price. And also they have changed something related to their capital ratio, putting more emphasis in their capital ratio instead of leverage, and more clarity on the PCT consideration that they have included in their methodology. I'm glad that my friends here talk about, give us hope that there would be some changes in their methodologies. I think that there is, of course, hope and engagement from all stakeholders, from multilaterals and the credit rating agencies to going forward with this, this movement. But everybody here more or less talk about PCS and all the factors and methodology. I'm going to bring other two important aspects that I'd like to share as risk manager. One is related to the first panel, is our lack of standardization. Among ourselves, the MDBs, we don't share a common framework in terms of risk metrics and capital metrics. Of course, that we do share all the views from different methodologies from the CRAs that use complete different methodologies, different indicators, but we don't have a common set of own indicators that can allow us to compare ourselves in a very wonderful and straightforward way. And this is very important for us, because it will help us not only in our internal decision-making, because we can compare with each other, but also it will give more transparency to the whole market. This is very important for us. Because since we are not regulated, it's very important to have this common framework in place. So we, MDB community, need to take ownership on this issue. We must define this set of indicators and be compared with each other. Another thing that I'd like to bring to the table is the reinforce the significant enhancement that MDBs and PDBs are making in their risk appetite frameworks, risk culture, and capital strategies. Matt mentioned about all these new capital instruments and credit enhancements that we are doing. This is a reflection of all the capital adequacy frameworks that we are investing a lot of money and time. So, but what you see that still in the multilaterals, high levels of capitalization, liquidity, and very conservative buffers observed. And these, of course, are pretty much influenced by the rating targets and CRA methodologies. But let's be honest, this is also part of our DNA. I mean, being very conservative is really deeply embedded in our institutional culture. So as risk managers, I think we have a huge responsibility that goes beyond just advocating for CRAs to better capture the risk profile in their methodologies. We also need to drive conversations internally within our institutions. This is also our major challenge. Changing culture is not easy. We have issues with data quality. I'm glad that we talk about James. This is also our responsibility to provide more information to this database. There are a lot of concepts to be aligned. We need to have models in place, and we have to develop models and also validate. So I think there is an incredible opportunity for us. We have cutting-edge tools. We have AI advancements. We have a health of talent people, highly motivated to committed of practitioners to work in this scenario. So, and I think that FIX has a crucial role to play. So it must continue to support us and leverage this influence to ensure that MDBs collaborate, exchange best practices, and adopt the most effective solutions. I only think that only with this collective effort, we are going to strengthen our organization to work greater capacity and for development. So I think that is, I would like to thank you very much and all my friends here for this wonderful panel.
Thank you.
Thank you.
Thank you very much. And we are running out of time, so I'm going to wrap up in one word, maybe James, and having a wish that next year, for the next Finance and Commons Summit, we will have more institutions declaring to this database. And just to finish, also one word about the fact that there is the closing ceremony today at 2 p.m. in plenary 1. Please be sure to attend. And thank you very, very much to all the panelists here and to the attendants for this beautiful panel. Thank you.